So in today's video, we'll talk about what a hedge fund is, what are the different strategies of hedge funds, and how you can actually invest in a hedge fund. I was scrolling through LinkedIn the other day when I saw that Citadel, one of the biggest hedge funds in the world, well, probably the biggest one, posted a $16 billion profit, which is honestly insane. Hedge funds have also been in the news for a lot of random stuff, following the GameStop saga, Archegos blowout. So what exactly is a hedge fund? A hedge fund, as defined by the SEC, are pools of capital that may or may not use sophisticated hedging strategies. What does that actually mean? Let's talk about it. So let's imagine I'm a trader at Goldman Sachs and I just leave Goldman Sachs because after 10 years I didn't get promoted to ED. I leave Goldman Sachs, so that's me, Emeka. I'm a trader at Goldman Sachs now. And I start trading my own money, and this is a pool of money right here. I start trading my own money and I'm so happy. I'm making 20% return, 25% return. And let's have a couple of friends. I tell my friends that, hey, I'm making all this money leaving the investment banking, and everyone's like, oh my God. So money is like 4 different people. And I tell them, hey, I'm making so much money and all of that. And they say, you know what? You're making 20% return. I'm investing in Apple stock. It's only giving me 10% return. They then decide to give me all their money, and all those pools of capital come together, now becomes a hedge fund. And if you think about it, famous mutual funds and stuff like that, like Cathie Wood or Soros for the Soros fund, those are the fund managers. So that will be me, Emeka. I am now the fund manager that manages the hedge fund, which is more or less just me and my mates' money pooled together as defined by the SEC. Now, what are the different hedge fund strategies? I'll go into a few. The most basic level, I'm sure you've heard about a few, like long short equity, dedicated short buyers, or even global macro. But what does this actually mean? I'm going to explain long short equity and dedicated short buyers and global macro in more detail, because I think that's what most people will be familiar with. Long short equity are basically hedge funds that go long a stock but also short the stock. So basically they will benefit if the stock that they went long on increases in value over time, so that way they make a return. But also if they short a stock, they also make money on that because the price is lower. But how does shorting actually work? This is how it works. Let's say you have Tesla stock and it's currently trending at $1. Let's say $100, make it simple. And you believe that Elon Musk is going to do some rubbish in the next couple of months and Tesla stock is actually going to go down, so decrease in value. What do? I'm going to short the stock and make money based on the price differential. So what you actually do in practice is you go to a broker and borrow Tesla stock, and now you're telling the broker, I'm going to pay you back. Maybe you think in 1 week the stock's going to plummet. I'm going to pay you back in 1 week. When you borrow $100 and then Tesla stock actually plummets and it's now worth, for example, half the price, and say it's 50. Now that it's worth 50, you can then buy Tesla stock at 50 and then sell it back to the broker, and you make a gain based on the price differential. But the most important part here is, if you're a hedge fund manager, you must know how to pick stocks. Like, you must have alpha. You must know something the market doesn't. You must know that based on this analysis I've done, I believe Toyota stock is going to go down, or I believe Tesla stock is going to go up. The next most common type of hedge fund is dedicated short buyers. These are hedge funds where they are 90% or 80% short. They're mostly short and have a few longs here and there. Most of these hedge funds typically also have like research houses that publish negative news about different companies. So they could publish something about Aramco and say maybe they're cooking the books, and they have a short position in that. So that way, if people start selling and the stock goes down, they are able to make money. The next most common type of hedge fund is global macro hedge funds. And these are hedge funds that make money based on trying to predict macro events. What do I mean by that? Let's take, for example, during COVID. And it's actually funny, my lecturer at that time actually told us what to do. When COVID was about to happen, and when it was already happening in China, he literally said, short airplane stocks. Their value is going to tank because people will not be able to travel. And that's literally what global macro managers do. They would have seen in COVID, travel is going to reduce, tourism is going to reduce. I'm going to short various industries like that will be impacted. So there's a bit of an overlap with long short equity. But example as well, global macro funds could also short oil. During COVID, we couldn't go anywhere. People were stuck at home. The price of oil tanked. It actually went negative. And if you shorted futures at that time, you would have made money. So this next slide shows the quarterly performance of long short equity indexes from 1994 to 2020. So there's a lot of data in this. And what it shows is, if you look at the red circle, it shows that in the dot-com crash, when equity markets crashed as well, hedge funds also crashed. It just shows that during the financial crisis, hedge funds also didn't perform well. It was like minus 12%. And also during COVID, hedge funds didn't perform well. So it shows that hedge funds, the long short equity ones, are highly correlated with equity markets, which you should think about if you're trying to invest in a hedge fund. So this slide shows correlation a lot better. and correlation means the two instruments move the same way. So if Tesla is up 10%, is Toyota up 10%? If that's the case, then the correlation is 1. But if Tesla is up 10% and Toyota is only up 5%, then the correlation is 0.5. So for a positive correlated instrument, the correlation is between 0 and 1. And if it's negatively correlated, then correlation is less than 0 and is negative. So for example, if Tesla moves up 10% and Walmart goes down 50%, that means they're negatively correlated. And for diversification, you want to invest in instruments that are negatively correlated to create a balanced portfolio. So back to the slide, it shows the Credit Suisse Long-Short Equity Index, which is more or less a database of different hedge fund returns by Credit Suisse, and shows the MSCI World Equity Index. And you can see the greatest correlation, more or less this graph move the same way. It's like almost identical, and actually shows that from 2009 to 2020, these two have moved more or less in tandem, which is actually crazy. As you can see, the correlation is 0.9, which you think about is immense. What you should also notice here is the drawdowns seem less severe for the hedge fund index. I don't know, you can see, like for example, in 2009 during the financial crisis, the hedge fund went from 500 to 400. What we can see for the MSCI World Index, it went from 300 to just below 200. So that shows that hedge funds may actually perform better when there's a crisis. And this is confirmed in the next slide. As you can see from the slide, when equities are up, the MSCI World Index delivers greater returns than the hedge fund index, which is actually crazy to think about, because when you hear hedge fund, you think, oh my God, I'm going to make so much money. But that's not the case. And also, if you look at it, when equities are down, then you see hedge funds outperforming. So hedge funds are less down. As you can see, when equities are down, hedge funds return minus 1.35%, but the MSCI World Index returns minus 3.45%. So as you can see, MSCI World Equity Fund outperformed when everything was going good. When everything went to shit, hedge funds actually did better. You're watching because you want to know, how can I invest in a hedge fund? So I'm going to break it down. How do I actually invest in hedge funds? Due to regulations put by the SEC, to invest in a hedge fund, you must be an institutional investor, a pension fund, or an accredited investor. And to be an accredited investor, which is what a person could be, you must have a net worth of at least £1 million. And honestly, if you're watching this video, you probably don't have that. So what's the other option you have? The other option you have is to invest in a hedge fund through an index fund. So for example, I'm going to show you right now live. Now I'm going to type in hedge funds ETF, actually see what comes up. So you're going to see quite a bit. And now I'm going to click on this one. This is the ETF database. It's going to give me a list of different hedge funds ETF. If I scroll down, which is quite interesting, you can sort it by total assets, yearly return, average volume, and all of that. Now if you look at specific hedge funds, you can see that this one, the strategy shares Newfound hedge fund, more or less is a long-short equity hedge fund. And if we look at the SPDR hedge fund index, this is a multi-strategy hedge fund. So hedge funds don't only have to be tied to one strategy. A hedge fund could be both a macro, long-short equity, convertible arbitrage. You could combine loads of different things in one house. So that's actually good to know as well. And the last one I'll show you is this one, the IMGB DBI Managed Hedge Fund Index, well, in ETF. It's a global macro hedge fund ETF. So what you have to do is, the symbol here shows the ticker of the hedge fund, and you go on your individual broker app. I don't have those downloaded because of work, but you go on those individual broker apps and actually type in that symbol right there. It's called a ticker. And if your broker has that specific index, it will pop up. So one like this Invesco S&P 500 Hedge ETF, that will more or less be on most broker app, because Invesco is quite a good famous brand. So and also the Wisdom Tree one. So go to your different brokers, type in the ticker, here it's called the symbol, and see what's actually out there. If you're like me and you studied finance, when growing up, I've always wanted to, own my own hedge fund. And people want to own hedge fund because they think it's so lucrative, and they're correct. It's lucrative if you make money. But how do you actually make money? If you think back to my example I made earlier in the video, Emeka and me, I'm the general partner from the slide, and I would charge a fee for you guys using my knowledge to get some return. And then my partners, those 4 mates, are the limited partners. With hedge fund managers, there are typically 2 types of fees. There's a 1% to 2% management fee, and there's also a 30% to 30% performance fee. And important to know as well is the hedge fund manager will get a management fee regardless of if the hedge fund makes money or not, but the performance fee really depends on if they make money. Now there are other metrics such as the hurdle rate, and that's typically around 4%, maybe 2%, and the amount a hedge fund has to return before they're actually able to charge the performance fee. And also there's a high watermark provision, which basically means that, so let's say I have a fund, let's say it's a calculated gains fund, and I start the year 100 million, and based on my wonderful knowledge working in investment banking, do my masters, I end the year with 120 million, so I've gained 20 million. What do I actually earn as a manager? Because 20 million is what my fund has returned, but what do I actually earn as a hedge fund manager? Why do people want to have their own hedge fund so bad? Let's say your management fee is 2%, your performance fee is 20%, and your hurdle rate is 4%. What do you actually earn as a hedge fund manager? If you remember what I said that regardless of how they perform, they get the management fee. So I will get my management fee. So that will be 2% of my initial amount, which is 100 million. So 2% of 100 million is 2 million. So I earn 2 million just for more or less having the fund open. And now my performance fee is a bit more calculated. The performance fee is your return. So I return 20% because the initial investor was 100 million and end of the year was 120 million. So that's a 20% gain. So I do 20% minus my management fee, which is 2 million, minus the hurdle rate. And in this case, the hurdle rate is 4%. So basically, the hurdle rate is 4 million, and that will give me a performance fee of 2.8 million. So technically, as a hedge fund manager, I earn 4.8 million in that year based on the management fee and the performance fee. Now, you as an investor, what do you actually get? If you think about it, the 4.8% is my return and the hedge fund returned 20%. So the investors would get 15% of their money back, which is, very good. Most equities don't return that. I mean, if you're in crypto, you probably get more than that. But you as an investor, you as my mates would get 15% back.